I would just simply say this is not an end of the bull market. It is a correction. It's a subsidy. And when you see a country like India purchase 1.5 times the amount of gold that they bought all of last year in the first quarter, but then bring it home from the Bank of England, 100 metric tons. When you see Saudi Arabia and Egypt bring their gold, and a half a dozen African countries bring their gold home from the New York Federal Reserve, when you see all of this action that centers around accumulation and repatriation, I think it is telling where this ultimately goes, so much so that the level of gold held by the world central banks right now is just above where it was right before Nixon closed the gold window. And it's almost as if these countries understand that they are preparing for some sort of a gold standard.
Gold and silver prices are higher, with gold posting solid gains in early U.S. trading Friday. A dip in U.S. Treasury yields late this week is friendly for the two precious metals markets. Distinguished financial analyst Andy Schectman, the president and owner of Miles Franklin Precious Metals, states that the current market situation is not the end of a bull market. According to Schectman, India purchased much more gold in the first quarter than all of last year, while Saudi Arabia, Egypt, and several African countries are retrieving their gold from the New York Federal Reserve. Based on his analysis, Schectman predicts that this accumulation of gold indicates a preparation for some form of a gold standard. He notes that world central banks now hold just above the gold levels seen before Nixon closed the gold window, indicating a potential major shift. The gold market has seen unprecedented central bank demand for the last 2 years. Official gold holdings increased by more than 1,000 tons in 2022 and 2023. In April, the World Gold Council said central bank net demand totaled 290 tons in the first quarter of 2024, the strongest start to any year on record. Despite Western media narratives that might downplay gold's importance, Schectman emphasizes that the current price pullbacks should be seen as an opportunity. He firmly believes that gold and silver prices will rise significantly in the future, driven by a decline in the dollar's value. According to the latest Treasury data, China has sold $53.3 billion worth of US Treasuries and agency bonds within the first 3 months of 2024. In another example, during the 6 years, Russia saw its foreign reserve holding grow significantly as its US dollar reserves dropped, accounting for another 1.8% of the decline. Now we present the clips of Andy Schectman's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I don't know. I think I'm pretty an open book on my thoughts, and people I think understand where I'm coming from. And I would just simply say this is not an end of the bull market. It is a correction. It's a subsidy. And when you see a country like India purchase 1.5 times the amount of gold that they bought all of last year in the first quarter, but then bring it home from the Bank of England, 100 metric tons. When you see Saudi Arabia and Egypt bring their gold, and a half a dozen African countries bring their gold home from the New York Federal Reserve, when you see all of this action that centers around accumulation and repatriation, I think it is telling where this ultimately goes, so much so that the level of gold held by the world central banks right now is just above where it was right before Nixon closed the gold window. And it's almost as if these countries understand that they are preparing for some sort of a gold standard, which the BIS reclassified as the world's only other tier 1 reserve asset. So when you realize that we've seen accumulation and repatriation under the guise or under the opaque cover of Western central bank manipulation, they're using it against us. And do as they are doing, not as the rhetoric from the Western media, like Yahoo News and Reuters and all of these things talking about, well, it's too high, China's out of the market now, and all this nonsense. Tune it out and look at these pullbacks as a subsidy. And I mean that completely and totally, because I think before it's all said and done, gold and silver will be wickedly higher. But that really means that the dollar has fallen much more. And in an environment where we've proven to the world that holding the dollars in our treasuries, which have been the key to our supremacy, our hegemony, and our standard of living, is dangerous. That's something that will have consequences. The question really, to me, is was it intended or not? The mainstream media wants us to believe that it's China thinking the price is too high, so that they've stopped buying gold. And I look at this as one of the silliest premature conclusions I've ever seen. First of all, no one has ever believed the numbers that China puts out. That's always been the conventional wisdom that, they tell us they have 24, 25, 2,600 metric tons. Alistair McLeod believes they have 38,000 metric tons, over 5 times what we supposedly have at Fort Knox, which of course hasn't been audited since 1956. But it was always, you can never believe what they have, always. And you get this one report that shows that they've ceased buying for 1 month out of the last 20. And now all of a sudden, oh, the price is too high. The bull market's over. China's not buying anymore. I think it's crazy. And not only has China been buying for forever and not updating their numbers very frequently, we have no idea how much they own. They're also the largest producers in the world, and they've been producing at uneconomical price levels using our trade imbalance forever. So no, this is what this was a massive short position on COMEX, where the commercial banks were literally as extended as I've ever seen them. And so one would expect that there would be some sort of a pullback, hoodwinking the managed money into taking the other side of the trade. And, it's still well above its 200-day moving average. So there's still a little bit of room for it to correct. But no, this is not the end of a bull market. It is a correction within a market where, if you've been at this long enough, this is just part and parcel what to expect. But it's becoming far harder to do that in an environment where we're seeing such copious amounts of deliveries off of the exchanges. And 3-4 Fridays ago, we saw $500 million worth of gold bars be delivered to Brinks, Hong Kong, which many people believe is then trucked over to the Shanghai Gold Exchange and sold out because they purchase kilo bars, the mini contracts. So that's what the Shanghai Exchange trades. But you're seeing bleed downs in the COMEX and the LBMA, and also on the Shanghai Exchange.
Andy Schectman warns that shifting away from the dollar as the primary currency for oil purchases could trigger severe economic consequences for the U.S. This scenario, he argues, would have disastrous effects on various asset classes and the broader economy, potentially unfolding rapidly if OPEC nations and others follow through on moving away from the dollar. The U.S.-Saudi Arabia petrodollar deal has come to an end after 8 decades. The agreement, signed on the 8th of June 1974, allowed U.S. dollars to be exchanged for crude oil exports. It expired on the 9th of June, according to several media reports. Regarding the global financial landscape, Schectman says a rapid shift is imminent. He further believes that gradual changes, such as countries buying gold and moving away from the dollar, will culminate in a sudden economic upheaval. Let's get back to the interview.
Exactly what I've been saying on your show for over 3 years now, that when the switch is flipped, and that's why I like the term little by little by little by little, but then all at once, logarithmic decay. The little by little you can see. And I'll show you that here in 1 second, but you can see the little by little in all of these bilateral deals that are being struck, and using the bridge and selling treasuries and buying gold. That's the little by little by little. And yes, the all at once, every country in the world has had to stockpile dollars for 50 years. It was 50 years last week that the deal was signed, in order to buy oil. And if everyone had no incentive to ever hold those dollars again, the dumping of those dollars, this is the great reset I talk about, would create hyperinflation. As that tsunami of dollars hit our shore, overwhelm the issuer, the US, creating hyperinflation. And the byproduct of hyperinflation is to see interest rates rise to compensate, not directed by the Fed or Powell, who doesn't want to do that and blow everything up. But if the market does it, we now have a villain to point to. Those guys dump the dollar. They're not taking the dollar for oil any longer. It's Xi Jinping and Putin and OPEC and Saudi Arabia. How could they do this to us? Well, forget about the fact that we signed an executive order to go green, or that our bonehead, knucklehead, embarrassing lead economic advisor, who embarrassed himself horribly in that video that circulated around Twitter for the last few weeks about him trying to explain money creation and bond sales. His whole theory is to lose the reserve status. And when we talk about the share of reserves, as of just a couple of days ago, gold's share of global international reserves has jumped to 17.6% in 2023, the most in 27 years. The share has almost doubled since 2016 as central banks ramp up purchase. But here's the interesting part. Gold is now the second largest asset held in global central bank reserves, exceeding the euro for the first time ever. The number one is still the US dollar, but its 48% world share is down from 60%. Meanwhile, the central bank's net gold purchases saw a record in Q1 2024. They're selling dollars they're selling euro, they're selling treasuries, and they are buying gold, which can't be sanctioned. And so, yeah, the all at once hasn't happened yet. But how hard would it be for OPEC to say we're done taking dollars for oil? That's the rumor that's been circulating around the internet, that the petrodollar deal wasn't renewed. Now, I would be the first one to scream that from the rooftops, but I haven't seen any official acknowledgement of that yet. So I'm not going to run with it other than to say a lot of people are saying it's already happened. I don't know if I can believe that or not. I never saw a 50-year timeline on the original agreement, nor have I seen any official statements from Saudi Arabia or the US. But I'll tell you one thing. We did see the United Arab Emirates say we don't want to take dollars anymore, and they're the seventh largest producer of oil in the world, and an OPEC member, and we're admitted into BRICS alongside Saudi Arabia. So to imagine an environment where the world dumps dollars because they're no longer needed for oil purchases, as every OPEC country is on the Belt Road, and all of these countries are moving away from this country because of sanctions and because of our behavior and because we're going green. So what do they need to work with us for? A currency where we've obviously chosen inflation over austerity, and a bond market that's been volatile as hell for the last couple of years. So yeah, time to move. And it's the safety in numbers. And if indeed we did see that moment, and Rafi is right, the all at once moment where dollars are forsaken because you don't need them for oil anymore. And to his point, every country in the world's had to stockpile them for 50 years. Yeah, the ramifications or the result would be disastrous, because you would see interest rates spike to compensate for that hyperinflation, and all of the assets in this country, stocks, bonds, real estate, and even the banks, which are over leveraged and undercapitalized, and the insurance companies are loaded with treasuries, they're all inversely related or correlated or valued to a massive spike in interest rates. So yeah, it would be disastrous, and it would happen very quickly.
World Gold Council predicts a potential upside for gold as the US dollar trades range-bound after a May decline, citing historical trends of gold performing well during prolonged dollar weakness. What are the potential long-term consequences of major economies moving away from the US dollar as the dominant global currency for trade? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.